So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have Euro USDs for our chart. All charts to be presented are to be at the same time frame, unless otherwise stated. Today, we're going to be mixing technicals with fundamentals. But we have to note here that, okay, there's not much about fundamentals going on. It's characteristic that the markets remained relatively stable, unchanged. You can see for yourselves that Euro USD remained in a rather tight range-bound movement between the 1.1005 and the 1.09. So more or less, we view the case for the pair to remain in a sideways motion between the prementioned levels, maybe even narrower. It's characteristic how the Bollinger Bands have narrowed. You can see it right here. While also the 50 and the 100 moving averages, that would be the 50 moving average is the green line and the 100 moving average is the orange line, have flattened out, exactly highlighting the sideways motion. The RSI indicator has reached the level of 50 and seems to be running along. So more or less, that tends to imply a rather indecisive market, which could also support the idea of a sideways motion being continued. Should, though, the bulls take over, we may see the price action rising, breaking above the 1.1005 and start aiming for the 1.1130. That would be a level which was last reached around the end of December, the last days of December last year. On the flip side, should the bears take over, we may see the price action dropping, breaking the 1.09 and start aiming for the 1.0825. Now, we know that the distance between the resistance and the support lines, especially on the support side, tend to be a little bit narrow. However, we see that being also a result due to the low market volatility of the past few days. Let's have a look at cable. Now, in a similar picture, albeit we have to note here that there is a relative stabilization of cable. And let me show you what I mean. You can see how there is an upward trend line which has been directing the pair, marking 1, 2, 3 higher lows and 1, 2, 3 higher highs. But overall, we have to note that since this point here, this jump here, there has been a relative stabilization given that there was no higher high, as well there was no lower low. They're about the same level. And the price action, as we had mentioned yesterday, tends to revolve around the 1.2720 axis, with the level being right now below the price action. So it's currently considered as to be a support. The RSI indicator, after bouncing slightly on the reading of 50, edged higher. However, nothing convincing for any bullish tendencies of the pair. Our sideways movement bias seems to be maintained, and I would expect the price action to breach even the upward trend line over the next 24 hours. Should the bulls once again take control over the pair, I wouldn't be surprised to see the price action aiming, and if not breaching, the 1.2810 resistance line, the first resistance line, and start aiming for the 1.29. On the other hand, should the bears take over, I would expect the price action to drop clearly below the 1.2720, breach also the mentioned upward trend line, exactly signaling an end of the bullish tendencies. And then I would expect it to reach, if not breach, the S2 1.2615, a level which was tested once, twice as a support line. So that's pretty valid. Some even mentioned this one, but in my opinion, that was a false break. So overall, we do have two instances where the level was tested substantially and held its ground. So that could be more or less a valid support line. Let's have a look at USD JPY. Now the picture here differs in the following sense that any bearish tendencies have been interrupted. And that's pretty clear. I would be deleting now the secondary trend. On the contrary, the pair has been moving, breaking clearly the 1.4390 and moving upwards. So we will be switching the role of the level from a resistance to support line. Let's go hunting for a new ultimate resistance level. Unlocking the chart, going back. Okay, there's one peak here, which clearly had some resistance. By my opinion, that was part of a wider sideways motion with a peak here. You can see how we had even advice for the sideways motion in the past by the levels set to the upside and the downside. That would be the, in red, 148.35. Locking it in. Let's correct those with the labels so we get a clearer picture. There we go, starting with the S1, which is now being placed at 140.85. The S2 at 142.50. The S1 at 143.90. The R1 at 145.20. Let's correct that. The R2 at 146.50. And the R3 at 148.35, as we have mentioned earlier. Locking everything in. Okay, let's talk about direction here. Now we have a couple of indicators which tend to point towards some bullish tendencies. And the first would be the RSI indicator, which has risen above the reading of 50. I wouldn't say substantially, but materially, definitely. Also, the upward price action seems to be implying such an outlook. Yet I'm not quite sure, actually. I would like to see the pair breaching above the 145.20 and actually touching the 146.50 before adopting any bullish outlook. And practically the main reason why I'm saying this is that I would require a higher peak than this one. I want to see the pair actually reaching the R2 before adopting a bearish outlook. And at this point, it would be interesting to see whether we have a new resistance line, a new upward trend line. And that would be something like this. But for that to come into play, once again, we need a higher peak than this one. So we need the pair to reach the R246.50 before adopting a bullish outlook. On the other hand, should the pair remain sideways, which seems to be the case, possibly between the R145.20 and the 143.90, mind you that the first support line may be pushed lower, and that's something which we could do right now if we move this here, and this here. And that would allow us practically to set the S1 at 143.40. The S2 at 142. And the S3 at 140.20. That's better. So you get a clearer picture of how the sideways motion is being maintained here. You can see, despite the false break here at the R1, that the main body of the price action tends to remain within the corridor formed between the R1 and the S1. More or less, that tends to imply a sideways motion. And should there be even a correction lower, which the market is currently hesitating, but it's still a possible break of the pre-mentioned upward trend line. Yet at the same time, the price action respects the S1. That would allow practically for a sideways motion like this. And definitely a possible break of the upward trend line would be a first signal of an interruption of the upward motion. Now, some are mentioning the possibility of a double peak. In my opinion, double top. In my opinion, it's still uncertain. However, should the bears actually be able to take over, then we would require the pair to break the upward trend line, once again signaling the interruption of the upward movement. Break also the S143.40, which also serves as a midline, and start aiming for the 142 support target, maybe with an outlook being on the 140.20, which was a pretty low point, maybe a little bit higher. These are the three main scenarios which could play out. So we have bullish, sideways, and bearish outlooks. And in each case, we have mentioned any possible prerequisites. But for the time being, we see the case for the pair to remain in a sideways motion set between the R1 and the S1. Let's move to the Aussie. The Aussie, which is still within the boundaries set by the symmetrical triangle. Once again, we wait to see whether the price action is going to be verifying the Elliott wave pattern, which seems to be emerging 1, 2, 3, 4, 5 as a peak. And then we have A, B, C. I would be highlighting here the fact that the retracement here has hit some solid ground, a floor at the 0.6680. Allow me to zoom out a little bit here. So that's going to be interesting to see. Should the price action be able to jump higher and break the 0.6865 resistance line, which was marked by this peak here, then we would be talking about a possible bullish outlook. That would be clear. Practically, you would have a continuance of the upward moving corridor, like here. It's actually pretty beautiful. Should, on the flip side, the bears take over, we may see the price action breaching the 0.6680 and start aiming for 0.6535, which was tested once, twice here, and to the upside, say for example here, which more or less highlights the validity of the level, as it was tested multiple times on both sides of the aisle. On the other hand, a possible sideways motion may also occur should the pair remain between the R1, namely the 0.6865, and the S1, the 0.6680. Okay, let's have a look at USD CAD. Also, USD CAD remains in a very, very range-bound, narrow sideways motion, with this being the upper level. And this being the lower level. I think that's pretty obvious. Also, the narrowing of the Bollinger Bands exactly highlights the low volatility of the pair, while the 50 in orange and the 100, the 50 in green and the 100 in orange moving averages have flattened out The RSI indicator has corrected lower and is just above the reading of 50, once again implying a rather indecisive market, which could allow the sideways motion to be maintained. So more or less the sideways motion scenario for the time being tends to remain intact. And for bullish outlook, I would require a clear break of the upper boundary, namely the 1.3405 resistance line, and the price action to start clearly actively aiming for the 1.3535 resistance level. That would be the R2 up here. On the flip side, should the bears take over, we may see the price action breaching the 1.3315 support line and start aiming for the 1.3175 support level. Okay, let's have a look at gold. We're escaping the FX market and have a look at the precious metal, which we had a very interesting jump during today's European session. Now we're talking about a rise of, let's have a look, around $15 to $16. And that was within 4 hours. Let's drill down to the hourly chart. Oh yeah, that was as the Asian session came to a close. Back to the 4-hour chart. And practically this sets the path for a possible break of the upward movement, the downward movement of gold. And I think that's the key issue here at this movement. Should the bullish sentiment be enhanced, then we may see the price action even breaching the R1 2050, which was providing resistance here and here. While even higher, we note the 2090 resistance barrier. On the other hand, though, there may be another correction higher, but not as high, and that can be respecting the R1 2050. In such a case, we may see a sideways motion scenario playing out, as did practically all this rectangle here. Despite having lower lows and lower peaks, you can see how the price action, the main body of the price action, remained within the two boundaries. So should the downward trend line be clearly broken, then I would be switching our bearish outlook in favor of a sideways motion bias between the S1 2025 and the R1 2050. We're talking about a corridor of around $25. It's pretty capable of keeping confined the precious metals price. On the other hand, should the bears take over once again, and this break prove to be a false break like this one or this one, then we may see the price action dropping below the S1 2025 and start aiming for the S2 1988. The RSI indicator is rising, nearing the reading of 50, implying that the bearish sentiment is fading away, and there is some uncertainty about gold's direction, and that may be exactly enhancing the possibility of a sideways motion. Let's have a look at US stock. Before we move to US stock markets, let's have a look at WTI. Now, this is WTI's daily chart. Allow me to zoom in a little bit. Okay, let's place some labels here so we get a pretty good picture of what's happening. By the way, feel free to send us any trading instruments you would like to have a look at, starting with the R3 being set at 80. The R2 at 77.55. The R1 at 74.35. The S1 turning now to support line at 69.90. In green. Second support line being placed at 68. And third support line being set at 60.45. Okay. And we can see how the price action remains in a sideways motion between the 69.90 and the 74.35. We have to note here that the distance between the resistance and the support lines tends to be very narrow. And actually, I'm feeling a little bit uncomfortable with that. That was more likely due to the downward motion which was expressed in the past. However, now the question is whether that's going to be maintained or not. We may be seeing the the commodities price breaking out with more force. Let's delete and clear the picture here. Okay. I would be raising the resistance line higher, as well as we're keeping this. 1, 2, 3. Could go even higher. But then I would be setting another resistance level here. And one at the top here. A little bit too flashy. Anyway, starting with the 5th, it's going to be set at $94. You can see how the pair was almost testing this level. Second, 89.40. Third, 83.45. Next one would be at 79.65. And the first resistance line is being set at 76.30. Let's move now to support levels as well. Okay, we're widening the game substantially here. Let's have a look at former shows. Could go a little bit lower. You can see how that was aimed once, twice here. So that's pretty valid as well. That's one peak, one show. You can see how this could go even lower. And then we have another one. think that should be enough. Okay, let's readjust the chart. Starting with the R3 being placed at 89.40. Sorry, my mistake, at 83.45. And it's being set here. 79.65 remains. $76.30 being the first resistance line. And then we have a very wide corridor within which the sideways motion is being played out. And allow me to set here a channel. Here you go. And then we have the 64.20. And the 61.51. Here you go. That's better. Although the support lines are still pretty narrow. And especially talking about the distance between the S2 and the S3. That tends to worry me a little bit. Let's keep it. So for the time being, we tend to maintain a bias for the sideways motion of WTI's price to be maintained. And we're basing this on two factors. A, that the price action has stopped producing lower lows. You can see how this one was the lowest point in the recent price action, but you can see that the next low was a bit higher. So that's one clear indication, in my opinion, that the sideways motion, or if you prefer, the price starts stabilizing. On the other hand, though, we have a downward trend line which is guiding the commodities price lower. It's going to be interesting to see how that plays out. The RSI indicator is at the reading of 50, just below it actually, implying a rather indecisive market, which may allow the sideways motion to continue. Yet, for a clear-cut sideways motion scenario, I would require the pair to breach the downward trend line and remain between the R1 and the S1 boundaries. Okay, let's have a look at US stock markets, and we have a divergence in the movement here. Let's start with the US 500. Okay, we have a sideways motion between the 4816 resistance line and the 4700 support line. I think the fact that the price action remained very stable yesterday and during today's European session tends to hint towards a continuation of the sideways motion, albeit the RSI indicator is still above the reading of 50, implying some residue of a bullish sentiment in the market. also note how the moving average, and we're talking about the 20 moving average, the 50, and the 100 are all pointing upwards, implying a continuation of the upward trend line. And that would be clearer if we drill into the weekly chart. Oh yeah. Back to the daily chart. So for the time being, we tend to maintain a bias for the sideways motion to be maintained. Should the bulls take over, I would require the pair to breach above the 4816. While on the flip side, should the bears take over, I would expect the price action to breach below the S1 4700, which is very, very probable if the market sentiment starts turning sour. And mind you that the distance is not much. We're talking about 60 ticks, which is actually pretty low volatility for the index. Could make such a distance within a day easily. Let's have a look now at Nasdaq. Nasdaq, in contrast to, say, for example, S&P 500, edged higher. And at that point, we note that there is an upward movement, but more or less in a sideways motion. It's pretty wide, and allow me to draw some sorry, here you go. Yep. Let's not forget this is the daily chart. So we have a sideways motion, given also the fact that the price action has hit the ceiling at the 16,950. A relative stabilization between the R2 and the S1. So this comes out of the picture. And here you go. Voila. Let's add also some labels, just to get a better sense of the resistance support lines. S3 being placed at 15,340. The S2 being placed at 15,735. The S1 at 16,165. The first resistance line now being placed at 16,950. Let's color this in red. Second, the resistance line at 17,500. And last resistance line at 18,000. So practically what traders are doing here is probably selling at the top, buying at the bottom, which is quite interesting. And we tend to maintain here a bias for the sideways motion to continue. For a bullish outlook, I would require the index to breach above the R1 16,950 and start actively aiming for the 17,500. On the flip side, should the bears take over, we may see the price action dropping, breaching the 16,165 support line, and start aiming for the 15,735 support level. I know it's a bit narrow, but we have to note here that there was also another sideways motion here and a peak here, which tends to support the value of these levels. We could widen them, but given the short-term perspective, I think we're pretty much in. Let's have a look also at Dow Jones. Will be our last chart. Very, very, very tight range-bound movement. Let's add some labels as well here. Starting with the R3 at 38,860. The R2 at 38,350. The R1 at 37,830. The S1 at 37,295. Let's color this in green. S2 at 36, 770, and the S3 at 36,255. That should sum it up. Once again, sideways motion scenario being expected for bullish outlook. I would require clear breach of the R1 37,830 and the price action to start aiming for the R2 38,350. On the flip side, should the bears take over, we may see the price action breaching the S1 37,295 and start aiming for the S2 36,770. So that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
To another video of IronFX. My name is Emily and today we'll be looking at margin level. So what is margin level? Margin level indicates the health of your accounts. It is the percentage value based on the amount of equity versus used margin. In other words, margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade, and the lower the margin level, the less free margin you have available to trade. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. Your trading platform will automatically calculate and display your margin level. If you don't have any trades open, your margin level will be 0. So why is margin level so important? Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set this limit at 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. Hope you found this video useful and interesting. In the next video, we'll be looking at margin call levels.
I think we'll go ahead and just get started. So, okay, let's get started. So, as per usual, a risk warning and disclaimer. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here is our agenda for today. So firstly, we'll go through which timeframes you should use for swing trading. And then we'll look at some graphical key elements, followed by identifying momentum. So this will be pretty similar to last week's momentum, when we talked a bit about the different indicators that you can use to identify the momentum. And then we'll look at breakouts versus reversals, as well as using correlation to fine-tune your strategy, because that tends to be pretty useful when you are looking at swing trading. So just let me know in the chat if there are any of you guys who like to use swing trading. I'm just curious to know as well. Okay, so here is a clear market structure example. So this is kind of the structure that we're looking for when we are going in for our analysis or choosing which timeframes to use. And this is an example for an unclear market structure, an example that we want to kind of stay away from. Okay, so which time frame is the most important? For swing trading, okay, so before I get into that, I just want to show you guys that the more important thing is to look for clear market structures. So you can see on the M15 here, it's pretty unclear market structure, whereas on our H1 view, it's pretty clear shape. Yeah, so there's two criterion here. Firstly, we want to look for a clear swing low or clear swing high. And secondly, we want to look for a clear trend between the starting and ending point. So this can be used for support and resistance levels. If you're using pivot points indicators, that works as well, and even your Fibonacci levels as well. So as for which timeframes to use for swing trading, these tend to be on the higher timeframes. So 1 hour to about your daily timeframes. So like, yeah, so H1, H4, and the daily timeframes as well. Those tend to be used for swing trading. Yeah, but as I mentioned, it's more important to look for clear market structures when you are determining which chart that you want to use. So I'll just do a really brief introduction to multi-time frame analysis. We went through this last week, but if you weren't here for our previous webinar, which was on day trading, I'm just going to briefly talk about this in this slide. So typically, traders will choose at least two time frames, such as a shorter term time frame and a longer term time frame. So it's basically a strategy that involves analyzing the market um, from multiple time frames so that you get an idea of the general trend of the whatever commodity or currency that you are trading. So the short time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall market direction. So you want to look for key resistance levels, trends, and patterns. And these tend to involve looking at your indicators, looking at your Fibonacci levels, so on and so forth. So, for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. So, conversely, if the longer-term trend is bearish, the trader may look to sell or short the market. As also if the shorter term trend is also bearish, then you would know that there is an indication of a strong downtrend in the market. So overall, multi-time frame analysis tends to help traders gain a better understanding of the market and gain more informed trading decisions by analyzing the bigger picture and trends and patterns from multiple time frames. Okay. So what exactly should you look out for? So price action wise, okay, these are obviously some of the basics that you should look out for on the higher time frames that you use for swing trading. But of course, in terms of price action, we're talking about past, present, and future momentums from the previous bar to dictate your strategy. So that brings us into our next point, which would be identifying momentum. Okay, all of these are kind of just tools that you can use to identify momentums and key levels. So the first key graphical levels, horizontal levels includes like your support, your resistance, and these tend to be supported with your Fibonacci levels, and including looking for Fibonacci confluence areas, so on and so forth. But we'll get into breakouts as well as Ichimoku clouds in the next few slides. And if we have time, I will also show you guys how exactly you can use these on an actual chart. Okay, so here, let's go through a couple of momentum indicators. So firstly, we have the MACD, and the MACD stands for Moving Average Convergence Divergence. So this line is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. So the signal line is a 9-period EMA of the MACD line. Okay, so basically it uses three exponential moving averages to identify price movements. And the difference between these averages is shown in a histogram, which you will see in the next slide, which is just the charts. And then, the graphs. And then the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action and are more suitable for identifying entry points. So the MACD triggers technical signals when the MACD line crosses above the signal line to buy or falls below, which is a signal to sell. So here is the example of it, just so that you get an idea of what I'm talking about. So the MACD line is the blue line, signal line is the orange line. The histogram that I mentioned earlier is just your bar charts or graphs over here. And then your zero line is, of course, just the dotted line there. So a selling signal occurs when the MACD line crosses over the signal line. And then the bullish or buy entry is over here. So when the signal line crosses over the MACD line, it's just the opposite of here. Okay, so this is an example, and our sell entry is over here as well. So basically, you just want to take note of each of the crossovers because that tends to indicate a change in trend or change in direction of movement. Yeah. Okay, but it's important to note that these tend to be lagging indicators as well. Like you can see over here, um, only when price has shown a reversal, then the next few lines, then we see price crossing over and indicating. So basically the red area indicates a sell. So this, yeah, it's pretty much a lagging indicator. So just keep that in mind if you're intending to use your MACD. Okay, let me know if there are any questions throughout the webinar. Okay, next, next momentum indicators, we're going to look at RSI as well as stochastic oscillator. So RSI oscillates between 0 and 100. Values above 70 are considered overbought, and values below 30 are considered oversold. So when the RSI value is above 70, it suggests that the security may be overvalued and due for price correction, potentially indicating a sell signal. And when the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. For stochastic, the readings above 80 indicate that price is near its high, and readings below 20 indicate that prices are near the lows. A security is overbought when the K line moves above 80 and oversold when the K line moves below 20. So here is an example for stochastic. So how we like to use stochastic as well as RSI is by looking at hidden resistances, divergences as well, which we'll get into in a little bit. But we do have webinars on purely on divergences, so you could go and take a look at those as well. But I'll briefly go through those now. So what we mean by a hidden resistance is that on our stochastic, we see that we have multiple swing highs that line up nicely at this 93.52 line. And on our price chart, we have price making a higher high at each of these lines over here that we've highlighted. So this is what we mean by hidden resistance. And then we can expect price to continue to respect this level here. Okay, here's another example of a hidden support or resistance. So we see that we have, and once again, we are using a stochastic indicator. So we have a hidden support level in this case, and on our stochastic, and on our price chart, we have this increasing trend line. Okay, so just to recap, what makes a valid trend line is if there are 3 significant touches, and you can see that we are expecting price to continue to respect this line because firstly, we have this ascending trend line, secondly, we have a hidden resistance here. Okay, and you can see that's exactly what it did, pushed it all the way to our take profit. Okay, so over here is an example of how we are using multiple indicators. So here we have the trend line, that's the first indicator. Second indicator, we are using the stochastic hidden support level. And we are also using our horizontal levels, so support and resistance levels, swing highs and swing lows to, basically to find confluence and analyze or forecast that our prices are going to rise to our take profit level. Okay, so I mentioned earlier a bit about divergences. So here is the first example, which is a bearish divergence. So bearish divergence happens when an RSI or stochastic has a descending trend line, or descending or descending. If it's bullish divergence, then that would be ascending. So Yep, so here's an example, whereas on our price chart, we can see that price is either respecting a horizontal resistance or it is making a higher high. Okay, so in this case, we see that price is making is respecting a horizontal level. Okay, first point, price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. Whereas on our RSI, we have a descending resistance line, which is basically descending trend line, and it caught the two reversals correctly, which you can see on our price chart. So what this forecast is that we could be seeing a reversal here as well. Okay, and you can see that's exactly what happened. Price reverses strongly because of the horizontal resistance, RSI resistance plus bearish divergence. And we can see that the RSI has also reversed very strongly. Okay, here's another example. Here is a little bit more straightforward. So we have price making a higher high and our stochastic making a lower high. Okay, and yeah, you can see that immediately after this divergence, price immediately dropped on on our price chart. Okay. So this is an extension of the previous example. In this example, we see price immediately drop, but we can see that it's rising again and it's approaching our resistance level here. So it's approaching this resistance level and we see a repeated pattern with the ascending, or rather price making a higher high and stochastic making a lower high. So it's the same pattern. We also have a hidden resistance level between these two swing highs, and you can expect price to continue to drop, which is why we call it a bearish divergence. And that's exactly what happened over here. Okay, divergence potential. So in this example, we see that we want to take note of where the bearish divergence started. So that's why you place a vertical line over here, as well as where we intend it to approach. So in this case, we see the bearish divergence making a higher high from this level to here, whereas our RSI is making a lower high from here to here, which is why we place our vertical dotted lines at these areas. Bearish divergence tells you that price is making a higher high, RSI is making a lower high. So we also highlight this area because price tends to reverse to the previous level where it started to diverge. So this is also basically a pullover, um, in this case, support level. Okay, because we see that price is expected to pull back to this same level here, pull back or retrace back to this level. And you can see that's exactly what happened here. Price reversed to where the divergence started to occur. Okay. Now, forecasting breakouts. We see this ascending trend line and on both our price as well as our RSI. But on our RSI, we can see that price has recently broken out of this ascending trend line, which forecast that price might we might observe the same thing over here. And you can see really close, if you look really closely, that price is barely breaking out of this ascending trend line, but also shows strong recent bearish divergence versus RSI. So we have a couple of pointers here that support our analysis that price is going to break out of this ascending trend line. Firstly, we have the RSI breakout over here. Secondly, we have the bearish divergence with price making a higher high and RSI making a lower low. Next, we have price breaking out of this ascending trend line here, And all of these points suggest that there is a high probability that our analysis that price is going to break out of this ascending trend line is actually going to happen, which you can see price broke and dropped strongly. Okay. Here's another example. In this case, we are seeing a descending. Okay, well, this is not a descending trend line because, as I mentioned earlier, we need 3 points for it to be considered a valid trend line. But this is a descending resistance line because we see these two swing highs on our price chart, and we also see the same two lines at the same spots for our RSI. Okay, so we see that our RSI is breaking out of this resistance level. Yeah, it's breaking out of this resistance level, and that's a suggestion or forecast that price is going to break out of this descending resistance as well. Okay. Okay, so price is now testing the descending resistance line. We're wondering if it's going to break it. Secondly, we have a descending line breakout, as we mentioned earlier, but we also have a bullish divergence. So, bullish divergence is basically the opposite of a bearish divergence. So we see that price is making a higher low on our RSI, and on our price chart, it's making a lower low. That's basically bullish divergence. So when you draw it out, it should look like this. Okay, so it suggests that price is going to continue to go upwards and break out of this descending resistance. Next, let's move on. So now we are looking at how we can play the continuation or breakout and reversal. Okay, so this is just a checklist for you to follow, especially if you are a beginner trader. It's just a good checklist to take note of a couple of things, or check for a couple of things when you are doing your analysis. Okay. So firstly, we have playing the continuation. Next, we're gonna look at playing the breakout. Okay, but we're looking at continuation first. So firstly, we want to see is price respecting Ichimoku. Secondly, is price respecting any trend line. Thirdly, is there any key horizontal support resistance level, Fibonacci levels that support these levels, and where's the next key level that it might go. Okay, so in this example, we are looking at a trend channel. So it's very obviously an ascending trend channel. What makes it valid is if there are two touches on top, two touches below, and you can see that it's continuing. So we are playing the continuation. What we mean by bounce and reversal in this case is not so much a reversal in trend, but more a reversal in terms of touching the walls of the trend channel. Okay, we see bounce off of the trend channel. That's basically what we mean by bounce and reversal in this case. Not so much breakout of the channel, and that's why we call it a continuation, because it's still continuing within the trend channel. So it's still moving within the trend, the ascending trend. Okay. Next, up on the other side, we are also looking at a descending trend channel just in the opposite direction. So we also see it bounce off of the walls of the trend channel just in a downward trend. Okay. Next, let's look at playing the breakout. So when we play the breakout, we mean crossing below the Ichimoku cloud, whether the momentum is in accordance to your analysis. Did price break any trend line? Did it break any recent key horizontal level? Or key Fibonacci confluence areas? And where is the next level that it could break out to? And then we fine tune it with Fibonacci levels and support and resistance areas. Okay, so in our first example, we are playing the breakout from this multiple swing high resistance. Okay, these tend to be areas more so than specific levels, which is why you can see that we've highlighted this area here. Okay, so price has broken out of it. We are expecting it to continue moving upwards for a couple of reasons. Firstly, we have this next swing high resistance here at the 135.147 level. Second point, we see it moving above the Ichimoku cloud, so suggests that it's a bullish signal. And then thirdly, we see that we have a 78.6% Fibonacci projection that also lines up with that same level. Once again, it doesn't have to line up exactly at the same level. I mean, it would be nice if it did, but these tend to be confluence areas more so than levels. So as long as it's near or close to it, that's fine. Okay, you can see that's exactly what happened here. So we moved above the 61.8% Fibonacci projection and move next, rise next to the next swing high resistance. Next, we have, in this case, a descending trend channel. Okay, so when we say breakout, you see it moving, still moving within the descending trend channel. So that's playing the continuation. But what we mean by breakout is you can see it's breaking out this ascending trend line. Okay, and it's also moving just below, or rather it's breaking out of the Ichimoku cloud. Okay. So we see this swing low support at the 1.03488 level, and we're expecting price to continue to drop to that level, which you can see it did nicely here. Okay. Next, playing another breakout. In this case, it's breaking out of the ascending trend channel. So in this case, we are using an inverted Nike tick or a Fibonacci extension. So for Fibonacci extensions, we look for ticks, or Nike tick, or basically anything in the form of a V shape, as long as the tail of the V shape is longer than the head of the V shape like you see here. Okay, so in this case, it's kind of inverted. So we see the 127.2% level. That's where price is at now. And the 161.8 is at this swing low support here at 0.66420. So we're expecting price to break out of this 127.2 and continue heading towards our 0.66420 level. Okay, and in this drift, you see that price it does test the 127.2 level a little bit, but you see that it ultimately does break through and hit our 161.8% extension level as we expected. Okay. So in the next example, price recently broke out of the descending trend line. Okay, so we see it break out, and we're going for a buy entry at the 100% Fibonacci extension. Okay, once again, this is a Nike tick. I think you can see the tick a little bit clearer now. So we are expecting it, or we are projecting it to hit towards our take profit, as well as the 161.8 level. Okay, and you can see that's exactly what happened. So it does test the 127.2 level. So that's what we can kind of expect it to do. But ultimately, it would still hit our take profit And it's not just by using the Nike tick or the Fibonacci extension strategy. We combine that with the upward momentum from breaking out of the descending trend line, and also from this buy entry uh, and the take profit, which are all levels of swing lows and swing highs. So pretty significant levels to take note of as well. Okay, next we're gonna move on to correlation, but before that, let me know in the chat if you guys have any questions so far. Um, Seems like we're all good. Let's move on to correlation. So when you're swing trading, correlation can be a pretty helpful strategy by comparing two different financial instruments or assets. So could be your stocks, currencies, commodities, so on and so forth. Okay. I mean, of course, in this case, we are talking about forex. So you can compare um two forex currencies that you're looking at in order to see or predict the different directions that they're heading towards. So a positive correlation means that the two assets move in the same direction, and negative correlation means that they move in opposite directions. And for example, if the price of gold and the value of the US dollar have a negative correlation, then when the price of gold goes up, the value of the US dollar typically goes down and vice versa. So the perfect positive correlation is +1 and a negative perfect correlation is -1. So in order for it to be considered strong correlation, we look for values of 0.8 and above or below -0.8. So basically 80%. Okay, so what exactly is it in the context of Forex and trading? So traders will use correlation analysis to identify potential trade opportunities and manage risk. So if a trader holds a long position in a Forex currency, they may want to consider taking a short position in a negatively correlated currency to offset some of the risk of the long position. So it's important to note that correlations can change over time, so traders must continually monitor their relationships. Additionally, correlation does not equal causation, meaning that just because two assets have a high correlation, it doesn't mean that one is causing the other to move. Okay, so here I have an example. My FX book has a correlation table that you can use to find the most or least correlated forex currencies in real time. So yeah, I've highlighted the time frames. You can choose if you're looking at a higher time frame, lower time frame. It's all there for you to adjust. And you can find currencies with correlations higher or lower than a certain percentage. So we typically will recommend looking for correlations higher than 80 and lower than -80%. So you just have to put that into the filter and it'll highlight all of the currency pairs that match up with what you have requested, that you can see over here. So it's a very easy way of finding correlations. Okay, they have pretty much all of the major currencies as well as a couple of exotic ones. So you can go on to myfxbook.com and take a look and play around with the currencies on your own. There's another correlation table from CMC. Yeah, so just giving you examples that you can look at. So here are a couple of correlated currencies that are positively correlated. So we have firstly the AUD and the Kiwi dollar, the euro and the pound, dollar index, CAD, and Swiss franc. Okay, so firstly, we're going to look at the Australian dollar as well as the Swiss franc in this example. That is 84.2% positively correlated. So in this first chart, we're looking at AUD/CHF, and this is what the chart looks like at that time in the 1 day time frame. And this is what the AUD/CAD chart looks like, also in the same time frame. So it's important that you want to use the same time frames to compare. And you can make use of the trading view feature that allows you to compare the charts at the same time. Okay, so yeah, so this is basically what it will look like if it is very correlated at that point in time. So you can see, yeah, whenever prices move upwards and downwards, it's basically about the same shape, I mean. Okay, and in this case, we are looking at pound dollar as well as the pound yen, and you can see that at this point in time, they are pretty much the same shape as well. So if you are analyzing the pound dollar, just solely by technical analysis, not taking into account any news events, any policy decisions, just by looking at technical analysis, if you analyze on the pound dollar, you can pretty much implement the same analysis for your pound yen, since they are pretty much almost the same and very positively correlated at this point in time, in this example. Okay, but of course things do change, and it's important to look at your fundamentals as well, which is why before you do this, it's important to look at the MyFX book correlation analysis so that you know exactly how correlated it is. Okay, another example, Kiwi dollar and Japanese yen, as well as the Aussie dollar and Japanese yen. So you can see once again that it's very positively correlated. Okay, another example, Kiwi dollar and Aussie dollar. You can see it's pretty much the same. Yeah. So if you can't see, it is a little bit difficult to see just by comparing these two charts, which is why we like to use the trading view feature that allows you to compare two charts on the same chart, two currencies on the same chart. Okay. Okay, this is another example. We're comparing the SPX with the euro dollar, and you can see they are also positively correlated. I think you kind of get it by now. So let's move on to negatively correlated. So negatively correlated currencies, some examples tend to be the DXY and gold, as well as the DXY and the Aussie dollar. So in this example, we are looking at the Euro Aus and Aus franc, which are minus 90.9% correlated. Okay, so this is the Aus franc. Okay, and this is the euro dollar. So you can already see that these charts pretty much look nothing alike, and you can see that's exactly correct. So whenever prices are dropping on our euro Aus, you can expect it to rise for our Aus franc and vice versa. Same thing in this example, we are looking at Aus dollar and dollar CAD. It's basically the opposite. Okay, and on the SPX and gold as well. So if you look at this chart, whatever you analyze on the SPX, just purely technical again, you can pretty much just reverse that for the gold analysis. So here is gold and US dollar, which tend to be negatively correlated a lot of the time. But of course, once again, remember to check before you do your analysis. Okay. And yeah, that brings us to the end of our webinar. Let me know in the chat if you guys have any questions, but if not, thank you guys so much for joining me today. Have a great rest of your week, and I will see you guys next week. Bye, everyone. Thanks, guys. Bye.